eBay and Amazon. There's a company that's not in business anymore called Overture. It was OVER. Made good money on Overture. Eventually got absorbed by Yahoo, and bought them at very reasonable prices, and they obliged me by going up. Amazon was the best example. It went from $16.09 a share to $63 a share in about 13 months. And Mike, if I had sold a covered call against Amazon, I would have felt like a chump, wouldn't I? I mean, if I bought it at $16.09 and sold a $17.50 call, how much of that upside would I participate in?
Well, only about
$1.50.
Yeah, about $1.50, 2 or 3% perhaps.
All right, but she went up to $63 a share, and you know, that was kind of cool, especially having the floor underneath me. Okay, let's go ahead and click the screen. They went up in value. They went way up. You know, Yahoo did pretty good. And I was blogging. I was telling folks about this, and soon people were asking if I had written a book about how I was properly setting up these married puts and also doing nested trades, which we'll get to later. Okay. And of course, Radioactive Trade and the Blueprint were born. When I originally sold the Blueprint, Mike, it only had 4 income methods. Okay, we were doing variations on the covered call. Selling a covered call is income method 1, because it was the first thing that I ever learned. All right, and then income method 2 had to do with rolling that call at a profit. That's why it was an income method. And then income methods 3 and 4 had to do with manipulating the puts. But Mike, what I began to do was put out free publications. This was before GoToWebinar. Put out a free publication called The Sketch, which is a mini blueprint, right? And it would teach folks, you know, the proper setup, and it would also teach income method number 1. And Mike, still, I teach the general strategy for free, lots of different ways. We do it with PDFs. We do it with, you know, on the site itself at radioactivetrading.com. We do it on this webinar. I've done it on my radio program, It's Your Money. Okay, and we charge very little for an expanded version. The expanded version, the blueprint and the CDs and so forth, you know, they cost, but they don't cost a lot. I learned very early on, if you give things a great value away for free, then amazing things begin to happen. Google was built on that, wasn't it, Mike?
That's right.
And now Facebook and Twitter and so forth. I mean, these are services that are free, but they have value. But then, even though it's given away free, then on the back end there are a lot of things where folks will find so much value that they'll end up wanting to pay you for more. And so that's what radioactive trading is built on. Okay, let's go ahead and click that screen. Over $500,000 in sales. Oh, let's go back. Sorry, go back one.
No, I'm sorry.
No, we went way back. And stop. Okay. Over $500,000 in sales later, I still believe it makes sense to show the value first and then make more available if people want it. Okay, and that's the offer that we'll do at the end. But right now I want to show you some things of great value. Okay? Now, Mike, I'm going to go ahead and run this poll here. Let's stay in this deal here. Would you rather have these two setups? Let's say you lose twice and you make money once. Okay? Would you rather lose 5%, then make 20%, and then lose 5% again? Or, next, click it, if we were to lose 8 times as much, make 8 times as much, and then lose 8 times as much again. If you were to lose 40%, now Mike, look at that, make 160%. When you make 100%, you double your money, right?
That's right.
Okay, when you make 160%, you more than double your money. You multiply your money times 2.6. Is that pretty cool? That's way cool. Okay, and then let's see. Then if you had a 40% loss after that, well then what? Let me just ask. I'm just going to ask everybody on the line there. Okay, what do you think would be better? The 5% loss and then a 20% gain, and then another 5% loss. Kind of flat, kind of boring, you know. Or would you rather something real exciting like, the opportunity that if you lost, you lose 40%, but if you make money, you make 160. But then, of course, if you lose again, then you lose another 40%. Which do you think you would prefer? Don't break out your calculators. I just want you to go with instinct right now. I'm surprised by these results. Are you surprised there, Mike?
I'm not too surprised. Are you? I mean, you are, I guess, but I'm not too surprised.
I am. Well, I'm surprised because a lot of times when we have options traders are very often lured by the idea of leverage. Okay.
Very true.
But something that they say. This is a saying that there are old traders and there are bold traders, but there are no old bold traders. And I think that that accounts for some of these results. Let me go ahead and share the results here, Mike. 88% said, I think I'm better off with these conservative losses. Okay, just keeping the losses down to 5%. And that's right. Okay, that's right. Here in a minute, we're going to show what these numbers would work out to. And 12% still thought that, geez, 160% return. Man, I'm into that. That works for me. Okay, but Mike, let's go ahead and look at what the results would be. Okay, the net result of the first option is a net gain of 8.3%. But if you took everything and you multiplied it by 8, okay, for example, if you used just strict options plays that were leveraged, and you could control 8 times as much capital, with a long call, for example. Well, geez, if you lose 40% and then make 160% and then lose 40%, you're going to have a net loss at the end. What if we went even higher than that? Okay, because some folks will say, well, 6.4% loss is based on 1/8 the capital, so it's really not that big a loss. Well, geez, if you went 10 times leverage, which is that pretty available with buying long calls and puts, Mike?
Absolutely.
10 times leverage? Absolutely. If you had a 50% loss, then a 200% gain, multiplying your money times 3, and then another 50% loss, you'd end up with, well, 25% loss. Okay? And the thing is, Mike, if you're able to keep your losses low, this is the point that I'm trying to make. Okay? If we look at keeping our losses low, it makes it possible for us to be wrong more often than right and still make money. Remember, losing 5%, making 20, losing 5. That's a net of 8.3%. Pretty cool. Okay? So the lie of leverage, a lot of times folks will say, well, I like to leverage because, I can use less capital. But, Mike, leverage can be used against you too. Let me give you an example. I'm about 170 pounds, 5 foot 6.5 inches tall. Okay, I'm a little guy. And I've been able to go out on the mat and defeat opponents that were 200, 250. I even beat a guy that was 308 pounds once. He was no slouch. He had some muscle to him too. But the thing is, I had a lot of more experience and background on him. I understand principles of leverage. And I had him tapping out because of, well, the position I put his arm in. It's all 4 of my limbs against just 1 of his arms. The point is, I don't fear fighting a man that's bigger than me because I understand the principles of leverage. On the other hand, what if that same fellow, what if the 308-pounder had the same background and experience that I did?
Well, then you'd be in trouble,
I
perhaps.
wanted to shake his hand. Yeah, I just want to shake his hand and be a nice guy. The fact is that leverage